Hey, bud. So today I am going to be talking about ARMs. But first, if you're enjoying these videos, like the channel, like the video, subscribe to the channel, I should say. This is going to help me reach more people that may be interested in using this approach to their real estate investing or just buying their first property. So, an FHA ARM. That is an adjustable rate mortgage. And what does this mean? It's a contrast to the fixed rate mortgage, which is by far the most commonly used product today. An adjustable rate mortgage will periodically change the interest rate that you are paying on your loan. And so I'm going to be talking about the structure of this product and just define some of the terms that you'll hear. And for the sake of keeping this consistent to what this channel is all about, I'm going to specifically be talking and using as an example an FHA 5-1 ARM. So the structure and the terms, an adjustable rate mortgage is for the most part going to have a 30-year maturity. So, standard, what you usually hear is a fixed rate 30-year mortgage. When you hear about ARMs, what you're going to hear is, an FHA 5-1. You're not going to hear that 30, but they are going to be based on, for the most part, a 30-year maturity. Now, the 5 is a 5-year of a fixed rate term, meaning that you pay that same interest rate for the first 5 years of this loan. After that, it's going to adjust once per year. And, how do they make that adjustment? This used to be based on the LIBOR, which is the London Interbank Offered Rate, or the CMT, which is the Constant Maturity Treasury. And the CMT is a weekly average yield of U.S. Treasury securities, and then that's adjusted to a constant maturity of 1 year. As of this year, the LIBOR is discontinued. This is kind of a long-term aftermath of the 2008 crisis. So the adjustments to these loans are going to be based on that CMT that we just talked about. Now, the next part of these mortgages is the caps, and I'm calling them the XYZ caps. For example, you could have a 5-1 ARM with, say, a 1-2-5. This means that the first adjustment to your interest rate cannot exceed a 1% increase. And then following that first adjustment, you cannot increase your interest rate by more than 2% in 1 year. And then the final number in that 1-2-5 scenario means that your total increase on your interest rate cannot exceed 5%. So say you have an initial fixed rate of 5% for your first 5 years. That first adjustment cannot go above 6%. And then the total adjustment cannot exceed 5%, meaning that your total interest on your mortgage cannot exceed 10%. Now, how do ARMs kind of come into play in today's market? Since we're in a rising rate environment, these can definitely become more popular right now, as that fixed rate term can come in kind of lower than what you'll get on a fixed rate product. But one thing that you need to definitely be aware of, though, is if you explore this option, is to be very honest with yourself in what your risk tolerance is. Kind of your risk tolerance overall for investing. These products definitely carry much more volatility compared to the standard 30-year fixed that most everyone will be using. Now, just kind of like some personal opinions and thoughts on how these products can be used in today's environment, or just overall. Like, say you're moving in 2 years, right? Like, regardless of the housing market condition, maybe it's a work thing, maybe you've already had this planned, but in 2 years you're definitely moving. In a scenario like that, you could use a 5/1 arm, and those monthly savings on that initial rate, that might be more attractive to you than the consistency of a fixed rate product. But if you're very unsure of your future, or you're very worried about the housing market moving forward, kind of on any uncertainty, if that's driving a lot of your decisions, or if you think you're someone that you're not going to be able to make that quick decision when, say, there's an opportunity to refinance, or maybe sell the property, this is probably not going to be the best product for you, and you're going to be better off in that fixed rate term. But there are definitely scenarios where this product is very attractive. Well, I hope everybody liked the video on this. And again, if you can subscribe to the channel, like the video, that's going to help me reach more people that may be interested in this, and hopefully help as many people as we can. All right, guys, have a good weekend, and I will talk to you later.